Hello everybody, welcome to Monday Morning Must-Knows. My name is Merlin Rothfeld, and here are 3 important things, I mean really important things to pay attention to for the upcoming trading week. Well, you know what? For the entire year maybe. Let's kick things off with our earnings announcements, which is going to be very quiet, but I got to get through them because there might be a couple names that are in your portfolio announcing earnings this week. There are 481 companies reporting. On Monday, you've got Coupa Software and Vail Mountain Resorts. Tuesday, nada. Wednesday, Lennar, so get your home builders, and Pinduoduo. You're going to get like 85 points in Scrabble for that word. Thursday is the big day, though. You got FedEx, Canadian Solar, Dollar General, Accenture, and then the meme stock favorite, GameStop. And Friday, well, we've got nothing there either. Now, here's where things get really exciting, and I'm really excited about this one. We heard all last year about raising rates, and no one really knew what was going to happen. Then it was maybe we'll raise 2 rates going forward. Oh, well, give me just a second. Let's paint a clearer picture on what might be happening there. What we do know for a fact is that on Wednesday at 2 p.m. Eastern Standard Time, Jerome Powell and the Federal Reserve are going to make a rate announcement. Right now, according to the Fed Funds Futures, there's about a 95.1% probability that they're going to raise 25 basis points. So let's look at a chart and put that in perspective. As you can see on the hard red edge of this chart, we've been flatlined since 2020. Right? It has been an aggressive drop. And mind you, before that we were at 2.5%, and in a period of probably about 6 or 8 months, we went from 2.5% to 25 basis points, or almost zero. Aggressive cutting to save the economy. But at some point, the economy is going to get a little too heated up, and now we're seeing inflation rear its ugly head. So if we do get a raise at this upcoming meeting, which right now, again, is a 95% probability, you're looking at that red line on your screen. So let's paint a clearer picture of where we're headed. As you can see on the hard right edge of this, I've added some bars after the 2022 at the bottom. Let's put in some goalposts and outline the entire year of 2022. That green line represents the meeting announcement happening for Wednesday, and then the red line represents the final Fed meeting in December. All that's in yellow is up in the air. We don't know exactly what's going to happen at those specific meetings, but we can start to anticipate and potentially forecast what might happen by looking at the markets. Now there's this thing called the Fed Funds Futures, and these are actually futures contracts that are tracking or pricing in the probability of specific rate increase points. So if we look at this chart here, we can see that at the December meeting, this is for December 14th, 2022, the futures have priced in 1.75 to 2% interest rates. Hold on a second. Let me do some simple math. Last September, I was told by the chairman of the Fed and the Federal Reserve that maybe 2 hikes in 2022. Now, let me see if I can do my math skills for everybody here. We're at 25 basis points right now. That's 0.25. 1 increase would be 0.5. 2 would be 0.75. 1%, 1.25, 1.5, 1.75, and 2%. Wait a minute. How do I get 2 out of 7? I went to the wrong math school. Right now, the markets are pricing in 7 rate increases by December, which is not a pretty picture for the U.S. markets. It's saying that inflation has really become an issue, and the traders themselves are betting, forecasting, if you will, that we're going to have much, much higher yields. All right. That said, that's all future and speculation at this point, but let's go look at the facts of what these numbers might mean to our markets. If we take a peek at this chart again, I'll look at that yellow goalpost box. If we raise from 50 basis points all the way up to 2%, you see that slow creep up. That's a long way, my friends, very high. And if we do just an arrow that outlines from where we are today to where the rate forecast is for December, notice the slope of that red arrow we just drew on the screen. If I take that angle and put it back to the last time we saw rate increases, which is really going back into, let's say, 2016, 2017, notice how steep that angle is. Even when we were in robust times in 2017, they were raising fairly aggressively. That was fine. But now we have an economy that may not be as strong as it was in 2016 or 17, and we're going to raise rates even faster. That's like driving down a road, a wet road, and slamming on those brakes. You could see a lot of skidding going on, and that's why we're seeing so much volatility in our markets right now. Just uncertainty going forward. Oh, but wait, there's more. We're going to dive even deeper into this stuff by looking at the yield curve. That's right, we're going to look at interest rates. Now, with regards to yield curve, some of you may not know what that is. A yield curve simply says, if we buy, let's say, short-term 3-month treasuries, right? So you're going to invest your money for 3 months, they're going to pay you X percentage. But if you invested for, let's say, 2 years, or 5 years, or 10 years, or 30 years, incrementally, you should be earning more money for the longer that you lock up your capital, right? It's just kind of it's a reward for the risk that you are taking. If I'm going to lock up my money for 30 years, you better be paying me a little bit more. If I'm locking it up for 3 months, I'll take a little bit less because I know I can get my money out real quick. That's called a normal yield curve, and it looks like this. You can see on this chart here, I have on the left side, we have 3 months, which is 3M, and then on the hard right edge, you see 30 years, and it's going to slope upwards. That's normal. In the middle, we have a flat yield curve, which basically says, well, if you bought a 30-year bond, you're going to make, let's say, I'm making up a number here, let's say 2%, but you could also buy a 3 months and make 2%. Where's my incentive to buy the 30-year? This is flat, and it's a sign of a stagnant economy and not really much optimism for the future. But then we have the dreaded inverted yield curve. Dun, 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 dun. This means that if you were to buy, let's say, the 10-year and get 2%, but you could buy a 3-month and make 3%, where's the incentive to hold your money long term? There isn't any. It's backwards. Therefore, you're rewarded for holding short term. And that gives us a clue that down the road in the future, not really that rosy for markets. And the inverted yield curve is one of the greatest, most reliable factors for anticipating a recession in the U.S. economy. If you go back historically, it seems like every single time there is one, I think bar 1 or 2 times when we have an inverted yield curve, we go into a recession. Same thing happened back in August of 2019, and we haven't had one since. So let's take a peek at that chart. Here you can see the difference between the 10-year and the 2-year. So it's taking that 10-year and subtracting that 2-year note. Now notice in the chart I'm showing you right here, you can see that sharp, steep move to the upside. That was going into early 2021. And what that tells you is that the 10-year was paying you a lot more than the 2-year. That's what should happen, right? That's what's called a normal yield curve. But watch what's happened recently. There has been an absolutely aggressive, almost free fall move in the spread between the 10-year and the 2-year. Now down at the bottom, you can see there's a little black line that says 0% on it. That is where that yield curve would be perfectly flat, where the 10-year is going to get you the same amount of yield as the 2-year. That is a dangerous thing. And if trends are any indication as to where markets may be going, this picture is painting a pretty good probability of an inverted yield curve. Now keep in mind, we just talked about on Wednesday the Fed raising rates. That takes the short end of that yield curve and lifts it even further, which could further accelerate the flattening and possibly the inversion of this yield curve. Now, of course, this may not be something to focus on for the next trading week, but as these weeks progress and the Fed starts talking more about raising rates and inflation and conflict going on all around the world, this might be something to help you reallocate your portfolio and reposition yourself to capitalize on a much weaker market going forward. That, friends, is your Monday Morning Must-Knows. We'll see you next week.